Good morning, everyone. Just give it another minute here while people go ahead and come in. All right. So, good morning, everyone. My name is Mallory. I am Congressman Eric Swalwell's District Chief of Staff. We are here today for a presentation and webinar on the employee retention credit. So we know there's been some questions coming into the office about the program, who can use it, how they go about doing so, and things like that. So we're hoping that this webinar today is helpful for you for that. Joining us are two other colleagues from my office. We have Phil and Asta, who are with us, and they handle together IRS and small business matters for the congressman. And the stars of the show today are Rena Newell and Roy Cheney, and they are senior stakeholder liaisons for the IRS and have been tremendously helpful to our office on issues in the past, and also for helping us out by putting this together here today. So thank you in advance for all the information you're going to be sharing with our constituents. To kick us off, I have a brief video message from the congressman. So I'm going to go ahead and show that to you now and see you on the other side.
Hi, I'm Congressman Eric Swalwell, and I want to welcome all of you who are joining today's webinar to learn more about the Employee Reduction Tax Credit and how it can help your business recover and rebuild from the COVID-19 pandemic. The Employee Reduction Tax Credit was created in March 2020 as part of the CARES Act, a response intended to assist small businesses that suffered from revenue losses during the pandemic. Since then, Congress has amended and extended this tax credit twice to be more useful to small businesses in particular, those who felt the effects of COVID-19 the most. The ERTC can be claimed separate from regular income or business tax filings through an amended return through the year of 2024, qualifying wages in 2020 and 2021, hopefully allowing enough time for small business owners to recover from the strain of the pandemic and its after effects. I hope you learn more today about how this can help you, because receiving this tax credit would allow many small businesses to make progress on managing other debts or revenue reductions that had emerged with their businesses during the pandemic. I also hope that today's webinar will provide some of you insight and guidance on how you and other small business owners in our community can navigate the ins and outs of the ERTC program as it has evolved. I also want to give a special shout out and thanks to Rena and Roy with the IRS for putting on today's webinar and for their assistance in helping navigate this tax opportunity. As always, please never hesitate to contact me, my staff, whether it's online, in person, over the phone, with any questions. We have an office in Castro Valley, and our casework team is happy to help you navigate this credit or any other issue. Thank you.
All right. So with that, I am about to turn it over to Rena and Roy. Before I do so, though, I want to let people know today is meant to be, of course, we understand each one of you has unique businesses and circumstances that may come into play and make this either more or less complicated for you. Today is really giving you general information and about how to access the program, and we'll be able to have Rena and Roy help answer those general and programmatic questions. For the more nuanced questions, though, that's why we have Phil and Asta on the webinar today. You can follow up with our team, swalwell.house.gov. You can submit a casework request through our website, and we'll get it to our team members, and they will then work with Rena, Roy, and their colleagues over at the IRS to get you the answers to make some of those more nuanced questions about the program. So So there's that. And then if you do have a general or programmatic question, we are going to use the Q&A feature to address those here today. So if the raised hand option is appearing for you, we're going to go ahead and forego that and go ahead and type those in directly into the Q&A, and we'll work on getting those answers. And if we run out of time and there are questions that we can't answer live on the call today, then we will go ahead and make sure that we follow up with you. All right. So with that, I will turn it over to the stars of the show and allow Rena and Roy to take it away. Oh, Rena, if you're talking, I think you're muted.
I'm so sorry. Well, welcome you all. Thank you. Thank you for participating in today's webinar. My name is Rena Newell and my co-presenter is Roy Cheney. I'm out of Oakland, California, and Roy's out of the LA area. Just a little quickly background on what we do as stakeholder liaisons within the Internal Revenue Service. We basically collaborate with all tax communities to provide tax education and information to various members. We participate in national and local tax-related events throughout the country. We conduct small business forums and multilingual working together sessions to share information, to gather feedback, and get your responses and concerns so we can better bridge the gaps between IRS and the community. Most importantly, we communicate priority outreach messages to all communities, including major employers, small business organizations, and community associations. And then we also deliver information on the individual and small business tax obligations as significant tax initiatives. So that's just a little bit of spill for what we collectively do, but I'll also allow Mr. Cheney to have a few words with you.
Well, I'm not going to too much, just to reiterate what Rena says. And basically, it's the same thing. For me, it's just in the Southern California area, in the Los Angeles County, all of Los Angeles County, as well as the Long Beach area. So Rena, go ahead and take it away.
Well, thank you. I hope I'm not on mute now, unmuted. All right. So today, we're going to talk about the Employee Retention Credit. And the Employee Retention Credit was originally enacted as part of the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, which was initially signed into law by the President on March 27th of 2020. And it was subsequently amended by sections 206 and 207 of the Taxpayer Certainty and Disaster Tax Relief Act of 2020. And I'm sure you all have heard it as the Relief Act, as well as the American Rescue Plan Act of 2021, known as the ARP. So the sole purpose of the Employee Retention Credit was designed to encourage employers to keep their employees on the payroll. The credit was available to eligible employers regardless of the size, including tax-exempt organizations that paid qualified wages to some or all employees after March 12th of 2020 and before January 21st of 2022. Now, there are different requirements depending on the tax quarter in which the wages were paid. Did I go too far? Sorry about that, you all. Okay. So now we're going to have a look at the various acts that were implemented. So what we're going to look at today are the evolution in employee retention as it started and some of the changes. We'll also talk about eligibility, qualified wages, and how to claim the credit. So looking at the various acts, under the original CARES Act, the eligible employers could receive a fully refundable tax credit against Social Security taxes equal to 50% of qualified wages paid to their employees up to $10,000 per employee annually for wages paid after March 12th of 2020 through December 31st of 2020. The credit was available to employers whose operations suspended or whose gross receipts declined by more than 50% when compared to the same quarter in the prior year. However, under the CARES Act, the employers that received loans from the Paycheck Protection Program, better known as the PPP, they were not eligible for the ERC under the initial CARES Act. So then comes along the Relief Act of the Consolidated Appropriations Act of 2021, and it made both prospective and retroactive changes to the employee retention credit. So for wages paid after March 12th of 2020 and before January 1st of 2021, the Relief Act made changes primarily to who was eligible to claim the credit by expanding the eligibility for the employee retention credit to employers that receive PPP. So now the individuals that receive the PPP loan, they are now part of receiving the employee retention credit based on the act from the Relief Act. Some of the other changes that the Relief Act made was they were basically making the credit available for the first and second quarter of 2021. They increased the maximum credit amount that could be claimed per employee to 70% of $10,000 of qualified wages per employee per quarter. And they expanded the categories of the eligible employers. In addition, they modified the definition of qualified wages and broadened the double benefit rules, which prohibited claiming multiple credits for the same wage payments. Okay. Then we move on to the American Rescue Plan, and that was signed into law in March 11 of 2021, and it added to the code as a new section 3134, which extended and made additional changes to the credit. The changes made were Q3 and Q4 of 2021 were applicable for the employee retention credit, and employers could claim a refundable tax credit up to 70% of qualified wages they made to employees from July 1st, 2021 through December 31st, 2021. This credit was claimed against the employer's share of Medicare tax instead of Social Security tax, okay? The legislation also introduced a new category of eligible employee recovery startup business, and they defined qualified wages more favorably for severely financially distressed employers. So, eligibility. Eligible employers were employers of any size that carried on a trade or business during the calendar year 2020, and one of the factors must have been met during the calendar quarter for them to qualify for the credit. And that was the trade or business operation was fully or partially suspended during any calendar quarter in 2021 due to orders from an appropriate governmental authority, or a trade or business that experienced a significant decline in gross receipts during the calendar quarter. So for 2020, if the gross receipts in a calendar quarter were below 50% of gross receipts when compared to the same calendar quarter in 2019, an employer would qualify. Now, they would no longer be eligible if in the calendar quarter immediately following the quarter, their gross receipts exceeded 80% compared to the same calendar quarter in 2019. And for 2021, the same rules applied regarding the full or partial shutdown, but who was eligible, who was an eligible employer and how the gross receipts were calculated, that did change. Now, I'm not sure if we have any government agencies attending the presentation today, so we won't discuss the government portion of the presentation. Just know that they are not eligible. However, for 2021, an exception did exist for any governmental entities if the entity was a college or a university, or the principal purpose or function of the entity was to provide medical or hospital care. So for 2021, a decline in gross receipts was defined as a quarter where the gross receipts of that calendar quarter were less than 80% of the gross receipts in the same calendar quarter in 2019. Also in 2021, a new category was added, and that's the recovery startup for businesses for third and fourth quarter of 2021, which will be discussed further in the presentation. Also, as a note, self-employed individuals are not eligible for their own services and earnings, and household employers are not eligible for the employee retention credit with respect to household employees. So what are qualified wages? Qualified wages are defined in section 3121 paren A of the Internal Revenue Code, and compensation as defined in section 3231 paren E of the code, paid by an eligible employer to some or all employees after March 12, 2020, and before January 1st, 2021. Qualified wages included eligible employers' qualified health plan expenses that were properly allocated to the wages. The qualified definition of wages depend in part on the number of full-time employees as defined in section 4980H of the code that were employed by the eligible employer during 2019. So if an employer averaged 100 or fewer full-time employees in 2019, qualified wages would consist of wages paid to any employee during any period of economic hardship. If the eligible employer averaged more than 100 employees in 2019, qualified wages were the wages paid to an employee for the time that the employee was not providing services due to an economic hardship, specifically full or partial suspension of operation by order of the government or a significant decline in gross receipts. Now, for those employers, qualified wages for an employee could not exceed what the employee would have been paid for working an equivalent duration during the 30 days immediately before the period of the economic hardship. For 2021, effective January 1st, 2021, the threshold was raised, and the businesses that had more than 500 employees in 2019 and businesses with 500 or fewer employees, they could pay qualified wages even if the workers were performing services. Now, the American Rescue Plan continued the 500 employee threshold, but they added a new category for the third and fourth quarters of 2021 for severely financially distressed employers, which was a trade or business whose gross receipts for the quarter were less than 10% of the gross receipts for the same quarter in 2019. basically there was a reduction in gross receipts of more than 90%. So just a few points that I'd like to make about qualified wages. Qualified wages include salaries and hourly pay, including healthcare plans and employment taxes. So that means self-employed workers, Schedule C or LLC single members, they don't receive qualified wages. LLC owners that are single members are not considered employees and don't receive wages because as sole proprietors, they simply draw funds from the expected profits of the business. So they're not receiving any paychecks. They don't have any federal Social Security or FICA withheld from the draws that they're taking. So they're not receiving paychecks at all. Now, if the sole proprietor has employees, they may be eligible for the ERC if the employer meets the eligibility requirements. And as for the S Corps and the C Corps, they can be eligible for the ERC because income that they earn, it is actually reported on and taxed on their individual tax returns. But we just have to make sure, and to be eligible, the shareholders must perform significant work and they must be legitimately on payroll and receiving payroll, I should say receiving pay for the services they're providing. And their pay must be also subject to the regular withholding. So at this time, I'm going to have Roy Chaney explain how to claim the credit.
Thank you, Ms. Rena. I hope everybody can hear me. Let's talk a little bit about how does an employer claim the credit? And it comes in a couple of different ways, what you should have done, and then what you can do now. So in order to claim the employee retention credit, eligible employers, you needed to report their total qualified wages on employment tax returns, which is 941 for most employers. But if you're an annual filer, you're going to use Form 944. If you're an annual filer for agricultural wages, you're going to use Form 943. Or if you're doing railroad retirement system, you're going to use Form CT-1. The credit was taken against the employer's share of Social Security taxes for the wages paid between March 13th, 2020 through June 30th of 2021, and against employer share of Medicare taxes for the wages paid from July 1st, 2021 through December 31st of 2021. Now, in anticipation of an employer claiming the credit, the employers should have retained the corresponding amount of the employment taxes that otherwise would have been deposited making your payroll deposits, which is including the federal income tax withholding, the employee share of Social Security and Medicare, and the employer share of Social Security and Medicare taxes for all your employees, up to the amount of the credit without penalty. So taking into account any reduction for deposits in anticipation of the paid sick family leave credit provided in what's called the Family First Coronavirus Response Act, and that's under the ARP. Now in 2021, small employers only, and the small employer is defined as employers with an average of 500 or fewer full-time employees in 2019 could have requested for what's called advance payments of the credit. And that would have been done on Form 7200. Of course, that form is now obsolete as that particular part of the process expired as of January 2022. So, excuse me. So from that standpoint, the credits were fully refundable because the eligible employer may have gotten a refund if the amount of the credit was more than your federal unemployment taxes the eligible employer owed at that time. Now, here's a couple of key points. To the extent the credit exceeded the employer portion of the employment taxes due, the credit was and is still treated as an overpayment therefore refundable to the employer as a refund. Now, again, we talked about in the beginning, that was the old way. Since these periods have passed, if you didn't take the employee retention credit and you followed the rules that Rena spoke about the eligibility, then you have the option of filing a Form 941X, which is an amended tax return. And if you do that, you'll be able to go ahead and claim the credit. Next slide. Under the CARES Act, the Employee Retention Credit, or ERC for short, was a fully refundable tax credit for employers equal to 50% of the qualified wages, which includes health plan expenses. So even if no wages were paid to your employees that the February pay their employees, it will still be eligible for the health expenses. This employee retention credit applied to all qualified wages paid after March 12, 2020 and before January 1st of 2021. The maximum amount of the qualified wages taken into account with respect to each employee for the year of 2020 is $10,000, while the maximum amount of the credit for an eligible employer for qualified wages paid to any employee was $5,000. $5,000 max per employee per the year of 2020. So as you can see, the math, that's 50% of the 10,000 gives you the 5,000 per employee. Now, the Relief Act increased the limit on per employee qualified wages paid after December 31st, 2020, but before July 1st of 2021, from 50% of the qualified wages up to 10,000 per employee for the year to 70% of the qualified wages up to 10,000 for each quarter, so that the maximum ERC amount for the first and second quarter of 2021 is up to 7,000 per employee per quarter. So as you can see, the changes were made to increase the percentage, also to make a change from yearly to per quarter. Lastly, under the American Rescue Plan, or the ARP for short, the limit on per employee qualified wages paid after June 30th, 2021 does still remain 70% of the 10,000 for each quarter, with a maximum of 7,000 per employee. And we're going to get to a few new concepts in a minute. But again, the ARP extended the employee retention credit into quarters 3 and 4 of 2021. Just as with the Relief Act, qualified wages are limited to 70% of qualified wages, again, up to the 10,000 per employee per calendar quarter. Thus, the maximum ERC amount available for 2021 is 7,000 per employee per quarter for quarters 1, quarters 2, and quarters 3. Now, some of the new concepts that was introduced was the introduction of what's called the recovery startup business. And that they are not otherwise eligible due to a full or partial suspension or a decline in gross receipts, with a credit limitation of $50,000 for any calendar quarter. And let me define what a recovery startup business is. A recovery startup business is defined under the Internal Revenue Code section 3134, paren C, paren 5, paren A, as a business that began carrying on a trade or business after February 15th of 2020, which really means what? You started during the pandemic. And in the preceding 3 quarters had less than 1 million in gross receipts. So therefore, if your business meets this definition, the total credit allowed is again 50,000 per quarter, and any wages you paid through December 31st of 2021 are eligible. You will no longer be limited to wages paid by the 3rd quarter ending September 30th, 2021, if you meet the definition of a recovery startup business. Secondly, there was an introduction of severely financially distressed employer, for whom qualified wages are defined more favorably. A severely financial distressed employer is a business who has experienced more than 90% decline in current quarter gross receipts compared to the same quarter in 2019. Therefore, the look back election should have been utilized to establish eligibility based on prior quarters for gross receipts. But no, IRS has indicated that tips can be considered as eligible wages for purposes of the employee retention credit, as long as they are also considered Medicare wages. And in addition, you can use the same wages for both the tip credit and the employee retention credit, because those are two different credits. Next slide, please. So as an eligible employer, your ability to claim the employee retention credit, or ERC, was impacted by other credit and other provisions. These are as follows. Retroactive to March 27, 2020, the new law now allowed employers who received the Paycheck Protection Program, because most employers did, commonly referred to as PPP, to claim the employee retention credit for the qualified wages that were not treated as payroll costs in obtaining forgiveness of your PPP loan. Therefore, the qualified wages not reported, I repeat, not reported as payroll costs on a PPP loan to request for forgiveness can be used to claim the employee retention credit. You just can't use the same wages to claim for the both. Now, this is not related to the employee retention credit, but it does deal with the PPP loan. And here's a little nugget. The COVID-related Tax Relief Act of 2020 amended the CARES Act, allowing deductions for the payments of eligible expenses when such expenses would result or be expected to result in the forgiveness of a loan covered under the Paycheck Protection Program. So no deduction is denied, no tax attribute is reduced, and no basis has an increase in it as defined by the reason of the exclusion from gross income of the forgiveness of an eligible recipient's covered loan. Again, this is for the PPP. This charge applies for taxable years ending after March 27th, 2020. So similar to the PPP loans, for the third and fourth quarter of the 2021 only, an employer cannot claim the ERC for qualified wages that were taken into account as payroll costs for the purpose of shuttered venue operator grant and the restaurant revitalization grant. So if you were part of any of those two and you received those, then this is something you need to take into consideration. These provisions were part of the American Rescue Plan. Now, an eligible ability to claim the employee retention credit was impacted by other credit and relief provisions, and they are as follows. Some of these may deal with you, others may not. Wages taken into account in determining the employee retention credit do not include, I repeat, do not include wages counted for the following credits. These are under the Internal Revenue Code 41, 45A, 45P, 45S, Internal Revenue Code 51, and Internal Revenue Code 1396. An employer may be able to take a credit under these sections with respect to wages the employer did not use, I repeat, did not use to claim an employee retention credit. A double benefit is not allowed. I'll go into a little bit of a brief explanation of those codes in a minute. For 2020, though, the double benefit restriction was limited to Section 45S, which basically states you're an employer who provided paid family and medical leave. Additionally, employees were not included for the purposes of the employee retention credit if the employees were used to receive a credit under Section 51, such that an employer could not claim the employee retention credit and the work opportunity tax credit under 51. Now, for the 2021, the double benefit restriction was expanded to again includes 41, 45A, 45P, 45S, 51. Therefore, the double benefit restriction for Section 51 for purposes was slightly different in 2021 because it applied to the wages used to claim that particular credit. Now, under the ARP, these sections 41 were removed out of the denial of the double benefit provision to an exception provision in qualified wages section. Therefore, the third and the fourth quarters of 2021, any wages taken into account to claim any of the listed credits cannot be taken into account for purposes of the employee retention credit. For more information, see the research and development credit, the Indian employment credit, the empowerment zone employment credit, and the paid family medical leave credit. These are the credits that pertain to the ERC sections 41, 45A, 45P, 45A again, and section 51. Now, let me give it back to Rena so she can give you some helpful reminders. I know this is a lot, but we try to give you as much general information as we can. Thank you.
And thank you, Roy. Thank you. So since we're wrapping it up, I'm going to just basically point out a few reminders. As Roy and I were preparing for this presentation, one of the things that we wanted you all not to get lost in was the various acts, the CARES Acts, the Relief Act, the Rescue Act. So I'm going to kind of define that a little bit better for you as we go through these reminders. So one of the things that you still have the ability to do is to claim the employee retention credit. Businesses can no longer pay wages to claim the employee retention credit for the pandemic. Let me rephrase that. You can no longer pay wages to claim the employee retention credit, but you have until 2024 to look back on the payroll that occurred during the pandemic and retroactively claim the credit by filing an amended return, okay? One of the things we also want you all to be aware of is there's a lot of scams by individuals as well as third parties promoting improper employee retention credit. Basically, they know that there's a lot of monies to be gained, and of course, they want to try to get in on it. So I'm going to just give you a few examples that were shared with Roy at a presentation last week. What he basically saw were individuals converting individuals who were contractors. They converted their wages to their earnings, I should say, to W-2s. So they may have originally received a 1099, but when they were going to get the employee retention credit to qualify their wages, because it's for wages, they basically made them a W-2 employee, okay? So that's one of the things. The second thing is individuals may say, hey, I can charge you a fee to amend your amended taxes, but whatever amount you get back, I want a percentage of it. Well, that's not how it should work. So we ask that you all be very diligent and aware of the individuals that you may have come on board to prepare you and give you the information that you're qualified for based on the requirements. But just make sure that you're being very cautious and making sure you have all your documentation properly available based on when you originally filed your returns. You should have those same documents. So if they're asking you for something that you didn't originally have, when you prepare the return for whatever reason, maybe you didn't need it, maybe it wasn't applicable to you, but just make sure whoever does that, that you give them your original documents. Okay. My screen's not turning. 1 second. So one of the other reminders that I have is the employee. So basically, as I stated earlier, the dates. We know that there's the CARES Act, the Rescue Relief Act, and the American Rescue Plan. But what I want you to emphasize on are the dates. March 13th, 2020 through 12/31 of 2020. Basically, you're eligible for businesses that can claim up to $5,000 per employee annually for the employee retention credit. So the credit can be claimed against 50% of qualified wages, paid up to 50% per employee for wages made between March 13th, 2020 and December 31st. For 2021, the employee retention credit was a quarterly tax credit against the employer's share of certain payroll taxes. The credit was 70% of the first $10,000 in wages per employee for each quarter. That means that the credit was worth $7,000 per quarter for Q1, Q2, and Q3, up to $21,000 per year for each employee. And then as Roy spoke about the recovery startup business, again, if a business began anytime after February 15th of 2020, their gross receipts did not exceed $1 million. They weren't eligible for significant decline in gross receipts or subject to the government shutdown. And they paid wages in Q3 and Q4. Then the recovery startup business were eligible to claim a credit of $50,000 for the third and fourth quarters of 2021. Now, I know we've had a lot of information, but I'm also going to provide you all with some resources that you can have a look at and to clarify any of what we've said or add to what we've said. Basically, we have, I encourage everyone to go to irs.gov, new tax laws extend COVID tax, basically the guidance, FAQs for the employee retention, and basically it also explains employers may be able to claim the credit, as we indicated, even after they have received the PPP loan. And there's a few more that we have. We have the notices 2021, guidance on the retention credit 2021-3, as well as the form 941 for the employment tax amending the employee retention tax. So I would like to greatly thank you all, as well as the Congressman's office, for providing us the opportunity to shed some information on a very convoluted topic. I think it's something that can benefit you all. And at this time, I'm going to turn it back over to Mallory.
Thank you so much. So the first thing I want to do is acknowledge that during the presentation, we became aware of a little bit of a glitch on the login side. So I know there are several of you that are with us now that weren't able to get in until a little later into the presentation. So I apologize for that, but we will try to make up for that by getting the recording of the presentation out to you as soon as possible. So we will work on that right away. And so now, if there's anybody that is with us that has some programmatic questions or anything like that, feel free to please put those in the Q&A. And then we will continue. You'll get another email from us. Even if you're here, we're going to go ahead and use that same list of the people that we had done outreach to get a link to the presentation out to them, to everyone, because we know that there was a bit of a login issue there. So let me go ahead and give people a second just to put in any questions that they might have. right. Okay. I'm not seeing any come in. So, with that, once again, thank you to, never mind, spoke too soon. I'm getting some now. So one question is about how long does it take for the IRS to send the ERC refunds? Is there an estimated processing time on that?
So let me kind of guide guide that answer. So, and I'll preface it with this. Um, Before I had the privilege of being at the 38th UCLA tax controversy, which was a partner between UCLA and IRS, with the Commissioner Reddick being the keynote speaker, and other heads of IRS within there, and having a conversation with CPAs, tax accountants, tax attorneys, etc. So and that was a question that came up, as well as the taxpayer advocate, Ms. Collins, was there as well. And there is no set time frame to receive that credit back. In general, you should be receiving processing an amended tax return within 90 days. Because of IRS's issues with processing things, we are a tad bit late. So the answer that goes out is, theoretically, we don't know it, but they work it as first in, first out. But just to clarify and add to that, one of the things that could hold up your credit is the fact that your credit was selected for review. Okay, so if your credit was selected for review, we have special employment tax revenue agents who are working the employee retention credit claims, because this, in essence, is a claim for a credit or a claim for a refund. And so one of the main things they said was to, in that situation, to constrict time and make things shorter. Please, again, to follow up what Rena said, please have all of your reiteration, all of your proof, all of your facts available. So you should be having all of those available when you first went to get the employee retention credit, or when you tackled it yourself and attended to put those things together. And that proof of information includes eligibility as well as the numbers. So just be aware of that. And that was the importance that Rena talked about in terms of the eligibility. Because sometimes where you may think I was in an area where they told me no, we were shut down, in essence, you know, that particular area, because it's mapped out, may not have been that. And so you may have to utilize the other portion, which is loss and gross receipts. So just something to think about, but they kind of correlate and coincide together.
Perfect. Let's see. So, so here we have somebody that has been receiving checks from the IRS, but they're not sure perhaps what program or under what circumstances that those checks are being issued for. Is there a way for them to find out which refund check is for what purpose? So they may have, you know, applied for ERC, but then also applied for, you know, a kind of refund or rebate under another program. Is there an identifier anywhere, do you know, on those checks? Or is that something that perhaps through our caseworkers, we can kind of help them figure that out with somebody from the taxpayer advocate's office?
Roy, as assist me if you can. I know if we look at the transcripts on their account, is there an indicator? I don't know right off the bat. Roy, had you run into that or not?
Apply. I'm sorry, I don't know if it sounded, but hopefully you can hear me. When you apply for a credit, it's basically a claim for a refund for that particular quarter. So you're filing a 941X, which is an amended for what quarter, for example, June of 2020. Therefore, if you receive a refund, the refund will have the period that is on the actual refund check. So if they have a refund check, you should be able to see the tax period ending. So if it's employment taxes, it would be March 31st, June 30th, September 30th, December 31st, and it'll have the year. Rena was also correct is, if you don't know, one of the things we try to promote, so I'll promote this out here while I can, is e-services. So e-services is something as an employer you should sign up for and start to utilize more regularly. And if you utilize e-services, as Rena stated, you can what? You can secure a transcript. That transcript will have the transaction on it and a date which says, oh, this amount was refunded. Compare that refund check with the amounts and they should coincide. So that's just another way to, go about doing it. But I would, for a business, secure that transcript, make a copy of the refund check, keep them together for my records, and keep those records for at least, the required, depending on what you're dealing with, collections or refund, 3 to 6 years.
Perfect. Thank you for that. All right. I don't have any other open questions right now in the Q&A. So I'll give people just another 30 seconds or so to, get those in if they still have them. But just one more time, Rena and Roy, the depth of your knowledge about this is invaluable, and we very much appreciate you taking the time to talk with our constituents about this issue. And we know it's a bit of a web, so untangling it can be a challenge, and we sincerely appreciate your participation with us today. And once again, to our attendees, if you still have questions, or that may be more particular to your business, Phil and Asta will be following up this presentation with another email. Please feel free to get in touch with them directly, and we will try to iron those issues out for you to the extent that we're able. So I don't see any more open questions. So with that, I will allow Rena and Roy to get back to their busy day, and for our attendees to get back to tending your businesses. We thank you for joining us, and we'll talk to you again soon.
Thank you all. Thank you for your time.
Thank you all, and thank you for your time. And also, if you have any members that are in the Southern California area, please, you have my information. Please have them call me.
I certainly will. We do some district director meetings, and I will share how well this went and how much we appreciate you. Thank you.
Great. Appreciate you. Thank you.
All right. Bye, everyone.
Bye-bye.
Bye-bye.